If you've ever watched price suddenly bounce at a certain level or get rejected out of nowhere, chances are you are looking at support or resistance in action. These two concepts are some of the most important things you can learn as a trader because once you understand them, the chart stops feeling random and starts feeling much more structured. Support and resistance are simply areas on the chart where price has reacted before, places where buying or selling became strong enough to change the direction of the markets. A good way to imagine it is to think of price like a ping pong ball being hit back and forth. When the ball drops toward the bottom player, they hit the ball and it reverses direction. When the ball reaches the top player hits the ball, reversing it downward again. That's essentially what's happening when price runs into support and resistance. Support acts like the market's floor. It's an area where price usually stops falling because buyers step in and absorb the selling pressure. As price gets closer to supports, more traders tend to see it as a good deal or an attractive level to buy, so demand increases. This increase in buying pressure often slows the decline or causes price to bounce completely. Resistance is the opposite. It's the ceiling of the markets, the level where price usually stops rising because sellers step in. When price climbs into resistance, traders start taking profits, new short positions open, and selling pressure increases. These shifts in behavior often cause price to consolidate, reject, or pull back altogether. So now that we've understand how support and resistance behave as markets floor and ceiling, the next step is to see how these levels actually appear on your charts. And the most common form you'll encounter is horizontal support and resistance. Horizontal support and resistance are the simplest and most common type. These levels sit at fixed price points straight across your charts. And the more times price has reacted to a level in the past, the more significant that level becomes. When you see price bounce off a level 2 or 3 times, that's usually a sign that buyers or sellers in that area take that price seriously. Understanding this sets the foundation, but to really use support and resistance effectively, there are a few core principles you need to know. Treat support and resistance like zones and not perfect lines. If you look at this weekly gold chart from around 2021 to 2023, you'll notice something important right away. Price never reacts to one perfect, razor-thin line. On this chart, support clearly sits somewhere between 1.6k to 1.7k range, while resistance forms around the broader 2k zone. Now, if you had drawn just a single line as your support level, you would have looked at this move here and thought, gold is breaking down, support is gone. But a few candles later, price snaps back up and reverses to the upside. That's the danger of treating support as a precise line. It makes normal price fluctuations look like breakdowns. A more realistic approach is to draw a zone or a box around the area where support or resistance clusters appear. This gives price breathing room it needs and reflects how the market actually behaves. Gold, like most assets, doesn't react to exact numbers. It reacts to areas of interest. And once gold finally broke above 2.1k zone with a strong clean breakout candle, the trend completely shifted. From there, buyers stepped in aggressively, momentum picked up, and gold continued pushing into fresh all-time highs where it's now trading above 4k. Another powerful concept is something called support resistance flip, and we can actually see a clean example of it right here on the H-bar chart. Price initially found strong support around the 0.05 zone. From there, it rallied into the 0.07 area, which quickly became our range. Support near 0.05 and resistance around 0.07. When price dropped back into the 0.05 supports, buyers stepped in once again and pushed price right back up to 0.07, and notice how price hesitated there, forming these indecision candles. Once H-bar finally broke above 0.07 with a clean move, momentum kicked in and price expanded all the way to 0.1. During that move, the previous 0.07 resistance flipped into support, helping price climb further toward 0.13. You can also see the flip working in reverse. After bouncing off the 0.07 multiple times, price eventually lost that support, and the moment it broke, 0.07 turned into resistance again, rejecting price on the way back up. Fast forward to 2024 and we got another textbook example. H-bar did a massive rally to around 0.33, but when the market cooled off and price began retracing, it bounced perfectly off the previous cycle's 0.13 resistance, which flipped into new support. Price reacted there twice, holding the level, before moving back into resistance and now retesting the support area once more. These flips make it clear how meaningful these levels are. When a previous support becomes resistance or previous resistance becomes support, it tells you a major shift in market behavior has happened, and those areas often become some of the best trading zones on the charts. Higher time frames carry more weights than lower time frames. When identifying support and resistance, always zoom out before zooming in. And this link chart is a perfect example of that. On the daily time frame, you can see a clear demand zone between roughly $11.5 and $12.5. This area acted as strong supports in the past, and price is once again reacting to that same zone today. That already gives us a strong higher time frame context. Now when we drop down to the 1 hour time frame, notice how Link begins building smaller support levels within that same daily demand zone. You can see multiple bounces and support resistant flips. This is exactly what confluence looks like. The higher time frame defines the major supports, and the lower time frame shows shorter term structure forming at the same area. When both time frames agree, that's often a high quality setup. The daily zone tells us where buyers might be waiting, and the lower time frames give us the timing, letting us refine our entry with more precision. So now the big question: how do you actually trade support and resistance? Let's keep it simple and apply it directly to this mental chart on the weekly time frame. First, mark the obvious support and resistance zones on the charts. On the weekly time frame, you can see that Mantle has reached its major resistance area around $1.4 to $1.5. At resistance, experienced traders may look for short setups. But if you're a beginner, you don't need to shorts. Just understand that resistance is a place where you generally want to avoid buying. As long as price hasn't broken above the previous resistance, we can expect this zone to act as a ceiling and potentially push price back down. Let's see how this plays out. Price eventually sold off and dropped all the way back into Mantle's strong support zone in the $0.5 to $0.6 region. Every time price dipped into this area, buyers stepped in and pushed it higher. If you were trading the setup, you'd wait for signs that the level is holding, things like green bullish candles or long lower wicks. Once you see that, you could enter a long near support. Put your stop loss just below the zone and target the next major resistance above. It doesn't need to be complicated. Buy near supports, aim for resistance, and manage your risk by keeping your stop just beneath the structure. If you enjoyed this breakdown and want more tutorials like this, make sure to subscribe so you won't miss the next episode. And if this video helped you understand support and resistance better, drop a like as well. It really supports the channel and helps more people discover this content. Thank you for watching, and I'll see you in the next video.